DCF analysis for JCPenney indicates that the company has been trying to recover over the past 5 years. They've made dramatic improvement, but the company's recovery has experienced some volatility along the way. Cutting down on capital expenditures since 2014 has had a positive effect on the company's cash flows. Looking ahead at future cash flows, we tried to take a conservative approach in trying to forecast the future for JCPenney. Using their DCF analysis, forecasting the future was actually quite difficult because of the volatility of JCPenney's cash flows over the past 5 years. So what we ended up having to do was basically use the previous 3 years because those seem to be the most stabilized years, the years their capital expenditures really decreased. As you can see by looking at the chart, our 16% forecasted rate will bring a gradual improvement in cash flows, but overall realistic improvement considering the nature of the industry and what JCPenney is going to have to do in the future in order to stay competitive in the marketplace and to stay competitive with online competition. In comparing JCPenney and Walmart and Amazon, you can see that Amazon and Walmart have a clear advantage when it comes to market cap. JCPenney's beta is about 0.94, meaning that since it's close to 1, JCPenney's stock will pretty much react to the market. So if the market has a bad day, JCPenney's stock will likely have a bad day, and vice versa. On a good day, JCPenney will move positively with the market. If you look at the PE ratio, you can see that JCPenney is 11.1, Walmart's about 16, and Amazon is about 97, which means basically, since JCPenney's PE ratio is at 11, investors can expect to earn $1 for every $11 they invest in JCPenney. So, given that into perspective, it's an opportunity for investors if they believe JCPenney can turn their fortunes around and start adapting and becoming more of an online competitor.
In addition to the previous valuation methods that we've discussed, two other methods that we want to talk about are asset turnover ratios and return on equity ratios. They're two good ways to kind of take a look at JCPenney as compared to their peers. In particular, we're going to look at Walmart and Amazon. Now, the data that we used was taken from the website Morningstar, basically a financial website, to keep it simple as far as calculations go. So as far as the asset turnover ratio goes, for JCPenney, now the data goes back about 10 years, so their results have fluctuated somewhere between 1.09 and 1.47 over the past 10 years. Just to do a quick comparison, Walmart, their asset turnover ratio in the same period has fluctuated between 2.34 and 2.48. What's interesting is actually Amazon, who, intuitively you would think would have a higher asset turnover ratio given that they don't have the same retail presence as Walmart in terms of the brick and mortar retail stores, actually has a lower asset turnover ratio of 1.78 to 2.74 over the past 10 years, which really could be a function of a couple things. With Amazon more or less devoting their capital to other resources such as innovation. It could be any number of things, but ultimately Walmart had the highest asset turnover ratio in comparison to the three companies. But I think the key takeaway here is that JCPenney has a relatively low asset turnover ratio in comparison to its peers. To also compare return on equity, similarly, you can take a look at the same website, which also includes data on return on equity. And JCPenney also has very different results from its peers in that way, and has actually ran a negative return on equity between the years of 2012 and 2016. Kind of struggling to really produce positive net income over that period of time. Comparatively, Walmart's been pretty stable over the past 10 years, fluctuating somewhere between 17.23 and 23.56, with really only the past 2 years having been soft for them. Overall, they've had pretty strong results. Amazon, though, has probably followed more in the footstep of JCPenney, where the past 4 years have been weaker for them. And this is really a function of the net income that they've seen over the past 4 years. But ultimately, not as bad as JCPenney. They've ran generally a positive return on equity number, with the past 2 years having been a little bit better than the previous.
This is the new section in JCPenney here in Olean. They will be bringing in major appliances. So part of the rejuvenation is happening in this relatively small store. I've looked everywhere and cannot find a Sephora, which would be a pretty cool addition here. I've also looked around the whole store, and this is pretty much the traffic level. And it is about 6 o'clock at night. Here's another vantage point of the store. Again, employees, that's it. Now, to be fair, it is a Monday evening, and it is 75 degrees outside. So I'm thinking people in southwestern New York are using the weather to their advantage. So maybe there'd be more cars at another time.
When it comes to market research, we decided to look at Amazon and the evolution of online retail and how JCPenney fits into the whole equation. Amazon is currently the largest online retailer in the U.S. with $89 billion in revenue in 2016. It is also the second largest in the world, only behind Alibaba, which is China's largest e-commerce company, which controls 80% of the Chinese market. In addition to high revenue in 2016, Amazon's stock is up 30% in 2017 so far compared to the full year in 2016. In addition to having a vast variety of products, Amazon takes care of shipping, returns, and customer service for all its orders and services. Due to all these factors, Amazon has dominance in the online sector with a continuous profit and stock growth valuation each year. Despite all the positive aspects of Amazon online shopping, it still does have a major downfall, which some say will be cause for loss of customers and revenue. It is reported that Amazon has poor working conditions for its employees because its main priority appears to be profit rather than its people. As a result, many customers are switching to different online marketplaces like Etsy.com and Jet.com, which also appear to be its current competitors. Additionally, Amazon is currently struggling with increased occurrence of bogus reviews. Some of these include false positive reviews or bogus sabotage reviews of products that it sells. In some instances, companies are even paying for one or the other or both. JCPenney, on the other hand, has had a slow but sure evolution to online retail. It has had double-digit online sales growth for both the fourth quarter and full year 2016. Not only has JCPenney had online growth, but it is offering the option of having delivery and pickup in stores, which is offsetting delivery costs and is one of the reasons why online sales have increased so much. In 2016, 75% of all online orders had touched a physical store. In addition to that, in the first quarter of 2017, JCPenney plans to expand online product assortment by more than 140% in order to accommodate all the interest that it has had from its customers. JCPenney's goal is to grow the store and e-commerce into a positive aspect that will create frictionless interaction between the two and at the same time increase the bottom line. Lastly, JCPenney offers its customers the option of booking appointments for its salon or portrait services online or within its app. It seems to be a hit with customers and a positive aspect that has increased revenue as well. Even though JCPenney's online presence is not on the same level as that of Amazon, I think it is moving in the right direction of providing its customers options for a better experience as well as cost savings.
For the final area of market research we conducted, we decided to look at JCPenney's pickup in store strategy. For some background, the pickup in store option is one where customers can order online and have the option of picking up their merchandise in store the same day. This is part of JCPenney's omnichannel strategy to integrate in-store and online shopping methods that was launched in 2016. Because the strategy encompasses both online and in-store visits, it's been difficult to quantitate exactly. However, JCPenney has been able to determine that this has become their second most profitable sector behind in-store purchases. An average of 1/3 of the pickup in-store customers spend an additional $50 when they visit the store to pick up their orders, further increasing sales. Also, this new strategy has made significant cuts to packing and shipping costs associated with traditional online orders, therefore increasing profit margins. The ease and quickness of the pickup in store feature has led to happier, more satisfied customers. So for now, JCPenney will continue to monitor the strategy and monitor how competitors like Walmart are using and adapting their pickup in store strategies.
So in conclusion, taking a look at our analysis, our ultimate recommendation for JCPenney are a couple things. It's a difficult climate right now for any retailer, particularly for a traditional department store like JCPenney. But there's a couple things we feel that JCPenney can do to stay competitive and to compete in this increasingly competitive environment. The first thing we would recommend is reducing their leverage. So, they've really got a lot of assets tied up in their stores, and maybe some of them are unproductive, even if they are, useful to some extent. So either close stores like they had started to announce in the beginning of the year, or at least make them more productive, such as when they converted, a lot of that in-store space to a retailer like Sephora, create more of those partnerships. The second recommendation we'd have is to actually pay dividends to their stockholders. It's hard to really be incentivized to invest in a company like JCPenney when you haven't been receiving dividends since the year 2012. And lastly, we recommend really kind of focusing in on the omnichannel presence that they're really going for from a marketing perspective. So beyond just web-based purchasing, but the mobile purchasing and the pickup in-store option, all of those things are going to give them, the same kind of competition level that a Walmart or a Target is currently winning at, or at least giving additional foot traffic to their stores in order to improve some of those sales. So for your typical millennial shopper, maybe they're enticed to come into the store to pick up something they ordered online, and then with the increased foot traffic and having the availability of partnership retailers like a Sephora, those sales may go up, and in the end ultimately kind of make those assets more productive, increase their net income, which will help their return on equity, increase their cash flows, and really ultimately make them a more competitive company going forward.